Hi, everyone. This is Alex Oliver. I'll be starting our webinar here in just 1 or 2 minutes. Just give everybody a chance to join in. As we're waiting on everybody, you can play around with the features. If you want to send questions in our chat today, feel free. I'll likely address most questions towards the end of the webinar, but I'll keep an eye on that chat box in case you want to engage and ask some specific questions. And for those joining, we're just going to give it maybe 30 more seconds for everybody to get in. Okay, well, we'll go ahead and get started. So hello, everyone. My name is Alex Oliver. I'm a wealth manager with First National Corporation. And every year we put on a financial wellness set of seminars, a financial boot camp, if you will, with Schwartz & Schwartz accountants. We've had a long partnership with Schwartz & Schwartz now going back before I joined First National Corporation, I think going back to 2005, where we now send clients back and forth for tax work or financial planning and have had a really strong relationship with them. And over the last few years, I've been helping to put on this financial boot camp just to give you some perspective on different financial planning strategies that might be related to your work at Schwartz & Schwartz. It's been a great partnership and happy to have you with us today. Today, we're going to be going over an investment vision for 2021. I believe this is the third year in a row we've done this webinar, where in January, I try to recap what's happened in the previous year, give you some perspective on what might come up in the coming year. And this particular webinar is going to be quite interesting. I mean, last year is just such a tumultuous year in so many ways that have affected so many people, whether that's with their loved ones dealing with COVID-19, or if you've been a business owner trying to keep your business afloat, or if you've been having your kids at home trying to teach them with remote learning. It's been a challenging year, and can be very easy to lose track of what's been happening, especially with last year's election and losing track of what's happening elsewhere. So I think today's webinar will help us to bring everything full circle. And looks like I need to share my screen here just to make sure everybody can see me. And let's just make sure we're good to go here. But as far as the year goes, there's just a lot of things that have really changed. And as far as the investment world goes, there's a lot of things that have just never happened before, a lot of new policies that have been put in place. So again, I want to give a little bit of a summary as to what has happened and look at things moving forward. I think I'll have a lot of information for you. I'll tell you right up front, I have a lot of slides to go through. I hope you'll find it very interesting. I had a hard time taking things out because I think you'll find it very useful, but stick to the end, because one of the last slides I think will be very useful for you as you think about your investments and planning for 2021 with everything that's been happening. So by way of just very quick introduction, First National Corporation, we are what's called a registered investment advisor, and we're located in the South Shore in Rockland, Massachusetts. So we're a completely independent company. We're not, Fidelity or Schwab or MassMutual. We manage our own clients' assets. We have a little over 400 families with $500 million in assets that we typically custody at Schwab or Fidelity and dictate their financial plans through with both their investments and their overall tax strategies, estate planning, insurance planning, things of that nature. And then we also have a retirement planning practice to our registered investment advisor practice, where we're managing a little over 50 retirement plans. That could be 401ks, simple IRAs, cash balance plans, things of that nature. So a lot of experience in all these areas. And we get hired as what's called a fiduciary service provider, meaning that legally we have to act in the best interest of our clients. So again, we don't have any products to sell, any mutual funds or anything of that nature. We're just giving advice based on what we think is best for our clients. So again, before we go into the webinar, just as a summary for our financial boot camps, today we are going over the investment vision for 2021. But just want to make you aware for our upcoming webinars this spring. The next webinar we'll do is in early February, the state of socially responsible investments. I know is a very popular topic that got more popular last year as renewable energy becomes more of a topic. The new administration will certainly make this a big priority. So definitely a big topic to tune into. I would encourage going into that. Budgeting for primary and vacation homes in a balanced financial plan. This was a big topic in 2020 because a lot of people were fleeing the city, trying to get to a more remote area. A lot of rural areas have just seen a huge spike in real estate prices. So as you think about having that first or second house, how that fits into your overall retirement plan, college savings plan, I'm going to go through some different ways to think about that. And then finally, the first million is the hardest, how envisioning the long-term helps you today. I think will really be a good comprehensive last webinar to bring this all full circle and see a comprehensive plan. So that way, you know, a lot of times I'm encouraging my clients to get that vision so they can spend more wisely now, enjoy it, knowing that the rest of their future is taken care of. So I want to show you how I go through that process with my clients. And so that webinar will be in April. schwartzaccountants.com/events if you want to sign up for those. And then we are always recording these webinars. So you'll always be able to get emailed a copy of that webinar if you're not able to make that specific time. But that website will also show you all of the previous webinars that we've done with Schwartz & Schwartz, categorized with retirement savings, the economy, college and student loans, or taxes and income. A lot of interesting topics here. They could be very specific, like health savings accounts, or they could be very broad, like how to fire, strategies for becoming financially independent. So I'd encourage going through those. Those are all on YouTube. You can watch them at 1.5 speed, so you can zip right through that. And I think you'll get a lot of knowledge by going through all these topics. Okay, and then very quickly, just a quick disclosure, consult an advisor, conduct your own due diligence before making financial decisions. Everything that I talk about today should be just considered entertainment and certainly not advice. These are my thoughts and my thoughts only, just on what I read, but I wouldn't take anything and go make trades today based on what I'm telling you. Okay, so let's talk about 2019 for a second. 1 year ago, I was doing the 2020 webinar, recapping 2019. It's always fun for me to go and re-watch that webinar and see what my thoughts were at that time for the upcoming year. You never would have expected COVID-19 to have the effects that it had. But let's just kind of remind us where we were 1 year ago. PE valuations were above the 25-year average. So previously in 2018, the stock market had gone down, but in 2019, we had a huge return. The S&P 500 was up almost 29%. And then it wasn't just the S&P 500, which is the 500 largest companies, but actually all sorts of different categories of stocks were up. So we usually categorize companies as large, mid-cap, or small. And then the stocks are also categorized as being value stocks or growth stocks. So a growth stock being a technology stock, a value stock could be like a Coca-Cola or Procter & Gamble. And in 2019, all categories were up 22% or more, which was just, again, phenomenal. So, we looked at that in the United States market, and then international equities at that time were looking relatively cheap. I remember kind of looking at that as far as the portfolios I managed and thinking maybe we should really be allocating more internationally here because valuations had gotten fairly high. But the American consumer was also doing very well. So debt payments as a percentage of income had fallen to record lows, 9.8%. And a large part of that is because interest rates were very low. So people were refinancing their mortgages or their student loans, and incomes were also rising. So again, the American consumer was doing very well, and job openings were actually higher than the unemployment population. So I don't have those numbers off the top of my head, but there might have been 7 million job postings and only 4 million people looking for those jobs, just as an example. And so again, the economy was kind of humming in January of 2020, and we would looking forward to the 2020 year saying, okay, we just had a great year in the markets. We might have slower growth in 2020, President Trump was favored to win the election that just happened a couple of months ago because, again, the economy was doing very well. Federal Reserve was not expected to raise interest rates because inflation was still very low, so still easy to get a cheap loan. And then that webinar that I did was actually on January 29th. COVID was still something that was happening in China, something that we were just reading about in the news. Only 5 cases in the United States had occurred at that time, and there were no deaths to COVID-19. China was on lockdown, so we were kind of thinking about how their GDP might be affected and how that might affect the overall economy, but not really considering what would happen in the coming months. And so obviously a lot changed. And I have as my first bullet point here that it's time to rewrite the finance textbooks because things were just happening that, again, had just never happened before. So just as a recap, the S&P 500 rose 3.3% through February 19th, and then lockdowns really just dropped the index quite substantially. I can remember a specific day sometime in that early March where the S&P 500 was down 11% in one day. You know, that was a stomach churning type of day where you just thought, what is going to happen next? But, you know, as the lockdown sort of receded, as we got new procedures in, as we got more tests, people were looking forward to a reopening economy. Obviously, vaccines were coming around, stimulus bills were being passed. And then if you just held on and did nothing, the index then rose 68% through December 31st. And we ended the year plus 16%, which, again, is just a phenomenal rate of return to consider, not only in January when I did the webinar pre-COVID, thinking about 2019's rate of returns, but then in the midst of COVID-19 shutting down businesses, I don't think a lot of people were predicting us to be in this place. So we'll talk about why that happened, but the biggest difference between 2019 and 2020's rate of returns is just how disparate they were. So I told you before that most stocks were over 22% rate of returns, but in 2020, U.S. growth was actually up 40%, while U.S. value was up 2.29%. So those technology stocks that you all know about, Amazon, Facebook, Zoom, or even Tesla, for example, I mean, they just saw phenomenal growth as we all work from home, as our buying behaviors are changing. You know, those technology companies were really positioned to capitalize on trends that were happening, but just got sped up last year. But then also, very interestingly, long-term bonds, if you were in a bond last year, those grew by 16%. A big reason was because for the first time ever, the Federal Reserve started buying corporate bonds. And this was just to make sure that liquidity was available. They learned the lessons from 2008 and 2009 when we had our real estate recession, that they needed to provide liquidity and get the American consumer back and going. So the Federal Reserve didn't have a lot of tools to their disposal. They couldn't lower interest rates much more, so they started buying bonds. And so that helped that market. And, you know, as we talk about stimulus, you know, there's a lot of bills. There's the CARES Act, and obviously the second set of loans that are coming now, and stimulus checks that are coming now. You know, Treasury rates fell from 1.7 to 0.93. And one of the questions is always, you know, where is all this stimulus money coming from? Well, it's because the U.S. Treasury can borrow money very cheaply, and inflation is just not picking up. And so they've been able to stimulate the economy and allow the consumer to have an opportunity to get back on their feet as COVID-19, you know, hopefully is solved in 2021. So obviously all this turmoil, Democrats now have the presidency, the House, and the Senate. So that would mean probably there's going to be more stimulus and potentially higher taxes, as we'll talk about as we go along here. Okay. So a lot going on. Let's put it into some charts, maybe some more digestible information for you. This is the S&P 500, just giving you some perspective over the last 25 years or so, going through our technology bubble in the early 2000s, our real estate bubble in the late 2000s, and then we really had some pretty consistent gains here. In 2015, we had a loss. But again, as I had mentioned, we had some pretty good years for quite some time with some small dips along the way. And then you can see just how drastic of a drop we had and how drastic of an increase we had thereafter too. So, you know, really puts into perspective over a 25-year period just how much volatility we've had over the last 1 year. When this is now brought us to a place where valuations are expanded. So this is telling you the price to earnings ratio of the S&P 500. price to earnings is just what am I paying for the right to invest in a company compared to what are they actually earning? What are they actually making for profit? And so we're always going to have a PE ratio that's in the 15 or 16 range. That's a 25-year average. But you can see back in the technology bubble in the 2000s, these PE ratios were elevated, and then that ended up leading to a minor recession shortly thereafter. You can see now that these valuations are elevated to those levels again, which might cause some concern. But there's a lot that's different now than what was happening in the early 2000s. I would say that two things that come to mind are, first, that interest rates are much lower than they were back in 1999 and 2000. So money is still very cheap. People don't really have a lot of place to put money to get a decent rate of return. So they're going to be more willing to buy a company that is priced higher because they just don't have many other options. Second, as we'll talk about, a lot of these companies that are valued highly are seeing just phenomenal growth rates. And so even though their current or 12-month earnings moving forward are not that spectacular, the growth rates that they may be expecting for the year after that or the year after that might actually make those valuations very justified. So just a very different sort of environment that is going to be difficult for us to adjust to as we find out who are going to be the winners and losers in this scenario. And again, I put this here just to put it in context because we have to be cautious when we're just buying index funds and just buying the whole market. What are the typical things that happen when valuations are this high? This shows you the correlation for 1-year returns on a forward PE and then 5-year returns. 1-year returns is not a lot of correlation. So this would sort of imply here that with a very high valuation, this is our axis here showing a high valuation, subsequent 1-year returns are not that great, just above the 0% mark. But again, the correlation is pretty small here. The scatter plot's all over the place. But if we look at 5-year returns moving forward, you can actually see we're in negative territory with valuations this high. So again, in a normal, quote unquote, normal environment, you might look at that and say, well, maybe the stock market is priced too high. Let's continue on here to see if that makes sense. Because what I think the people that are investing in the stock market are really thinking about is that 2020 is a wash. Companies, if they made money, great. A lot of companies were actually completely taking away their earnings forecast because they didn't know what was going to happen from month to month. But everybody was kind of thinking, well, with a lot of pent up demand, whenever COVID-19 is solved, and hopefully it's 2021, that there's going to be a lot of demand for people to get back to doing things that they were doing, go back to traveling, do their medical procedures that they had been putting off, and that would really stimulate the economy in a big way. And you could see from these estimates, the consensus estimates going into 2021, that earnings per share should actually be higher than they ever have been, not only because profits will be higher, but because a lot of companies were also buying back stock. So there's less shares in the market to be able to invest in. So there's definitely a case there that there can be a very quick rebound in the economy. But again, this might be the year where you want to be a lot more careful about what kinds of companies you're investing in because we've had such a split in valuations. So this chart is showing you the S&P 500. And in this case, we're looking at the PE ratios of the top 10 stocks, the largest stocks in the S&P 500 versus the remaining 490. And those top 10 are primarily technology companies. I mean, they've just grown phenomenally. And so I believe 7 or 8 out of those 10 are in what would be considered a growth category. And the top 10 are at a 33 PE ratio. On average, the top 10 are usually at a 19 PE ratio. Now, and the remaining stocks are at 19 versus an average of what they're usually at 15. So you can see a percentage of their average. Those 490 stocks certainly look a lot better on a valuation standpoint than those top 10. So we have to sort of make a decision here with these big gaps. And again, we kind of bring it back to the technology bubble. The last time we had such a big gap between the top 10 and the other 490 was, again, the technology bubble. So I have here a K-shaped recovery because some companies have recovered very well and maybe almost too well. Some really have a long way to go before they're going to get back to where they were. So we have to pick and choose here. Couple things to also keep in mind is that those top 10 are making up a much bigger weight of the S&P 500. So when you're investing in that index fund, you're more and more investing in Amazon or Facebook or what have you than you ever have before. But so far, to some degree, their earnings are backing it up. You can see the earnings of the top 10 are rising as a share of the S&P 500 than they have been in the recent 10 to 10 years or so. You could see that in the recession, there were some companies that were actually making a big part of the S&P 500, a very small blip there. But their earnings are rising, so they've justified it for now. The question will be whether they can continue that in the next coming years. Okay, so that's kind of somewhat of a more macro view of the stock market as a whole. Let's talk a little bit about overall GDP, because this will end up dictating what happens with overall fiscal policy, and that still will definitely affect stock markets as we go forward. So prior to 2020, we had been on a relatively steady 2.5% GDP growth. And as you can see in this table here, we had some pretty substantial drops in GDP. The second quarter, our GDP was down by about 31%, but then quickly rebounded 33% in the third quarter of 2020. We don't have fourth quarter numbers yet. But with any, if anybody kind of understands how the math behind this works, you can't just lose 30% and gain 30% and be back where you were. And that's kind of where we're at right now. We're not where we need to be to continue that trend growth. And so that's why most people say there's going to be more stimulus, because if we can take out a loan on a U.S. Treasury for 0.9 or 1% to hopefully get us back to that 2.5% growth rate, they're going to continue to do that. They're going to continue to stimulate the economy until we can get back to that point. Again, assuming inflation does not rise too quickly. And that stimulus, you see that happening in a lot of ways through direct paychecks to Americans that are making under a certain amount of money. A big reason for that is because the U.S. economy is unique in the sense that so much of GDP comes from the actual consumption of the American person. To compare this, I believe Germany's GDP, the consumption as a percentage of GDP is something like 53 or 54%. They're much more reliant on the production of actual goods. But here in the United States, we just consume more than the typical person. And so if people are going back to taking trips, buying vehicles, things of that nature, that's going to add to GDP more than other countries would. And so that's, again, why you see stimulus going directly to people. And to go along with that story of a recovery in 2021, I just want to kind of tell you where people stand individually, household-wise. They actually relatively are in a good place. I mentioned that at the beginning of 2020, debt as a percentage of income was at 9.8%. Now it has dropped to 9.1%. So again, people's incomes are relatively rising as a whole. Their debt payments are dropping as a whole. Some of you know, again, interest rates going down, but also some student loan payments were deferred. Interest at least was deferred. So people have been able to save quite a bit of money if they've been able to keep employment, obviously. And even if they didn't have employment, they had added benefits to their employment. So household finances are actually phenomenally, kind of unbelievable, but phenomenally in a very good place. Household net worth also still rising. You can see a little dip here as COVID-19 started, but still has risen as real estate prices have rose, as investments have rose. So the average American in a pretty good place. And then final one chart over here is to say that how much are Americans typically spending as a percentage of their income? And those stimulus bills that are going out to people are typically going out to people in the bottom 90%. And those people are spending 99% of their income. That's as of 2019. So most of those people are going to put that money that they just got from the government right back into the economy. They're going to buy things and they're going to pay tax on those things. And it's going to keep people employed. It's going to keep those businesses open. So that's why you hear people talk about that snapback recovery, that whenever we get these vaccinations done, these cases going down, people have a lot of money on hand. All those trips that they canceled in 2020, they're hoping to move them to 2021. Again, those elective medical procedures that they couldn't do last year, they're going to really be booking those up this year. So you might see a very quick recovery, at least for 2021. What happens after that is going to be very interesting to watch, because this is now showing you our federal balance sheet. So the federal government obviously is spending a lot of money. The lower right-hand corner shows you that the federal government's net debt as a percentage of GDP is now up to 100.1%. Whereas when I did this webinar 1 year ago, I think we're right around that 80% number. So GDP has gone down, debt has gone up, and now our debt to GDP is back to World War II levels. Okay, when we were actually funding a war, now we're kind of back to that level. So could that be a concern? Sure, yeah, absolutely. It could definitely be a concern for the federal government. And if it becomes a concern, that means rising interest rates, rising taxes, which would certainly stunt growth as that were to occur. Prior to COVID-19, I used to tell people that maybe in 2025, this would be kind of the problem we would need to deal with, because that's when the tax bill from 2017 sunsets. So somewhat easy to believe that tax rates are going to rise then. But now with everything that's happened, and obviously with a Democratic administration taking over all three branches, that could happen much sooner than 2025. So it's sort of a wait and see. Right now, as you see the total spending budget, net interest, despite all of the borrowing we have done, only makes up 6% of the budget. And again, that's because interest rates have been so low. And if inflation is going to stay low, those interest rates are also going to stay low. But the Federal Reserve will be compelled to raise interest rates if we have inflation, and that's when we might start to see a bit of a problem. So we're not really expecting a lot of inflation in 2021. That inflation rate right now is still running about 1.2%. I believe that's the number that's expected from today's report. So no reason to raise interest rates, but certainly something the Federal Reserve has to keep an eye on. They want to keep rates low for the next 3 years. Whether they'll be able to do that, we'll find out. Okay. Few other things to consider, and we're going to get a little random as far as our slides go now, because again, I just want to give you some perspective on where we might be able to find opportunity. This is going through the employment situation. And so obviously we had, rising job situation. As I mentioned, there was more jobs than people looking for work. Now, people left the workforce in a lot of ways. So when you see an unemployment rate of 6.7% or 6.1%, it's not really a number that you should pay attention to, because it doesn't account for the people that may have decided to stay home with their two children and are no longer looking for a job. The two children are remote learning, they're going to stay home, take care of the house. They're not part of that unemployment figure. Instead, this is a better way of looking at it to say, what kind of jobs have we lost? 22 million jobs from February to April. How many have we regained? About 12 million. So our economy kind of got up to here, and now we're back to those 2014, 2015 levels in terms of a jobs sense. And where are those jobs being lost? This is this chart over here telling you that, no surprise, leisure and hospitality has only gained 59% of the jobs back that they had lost in that February and April time period. So leisure and hospitality, trade, education and health services, professional services, these are where people need to hopefully regain their jobs. But even on a bigger picture than that, I'm sure most of you in this webinar know that the dynamic of how people are doing their jobs is completely different. Where we were all going into an office 9 to 5, Monday to Friday, some of us will never do that again in our lives. Maybe it's only going to be 2 days a week. And so whether we are actually going to need all those jobs in these categories, that's not for me to say, but those are the kinds of things that we need to watch as we start to evaluate these companies again. And that can be good or bad. Maybe some companies are going to fail because they can't get people to come back and do their jobs anymore. Others are going to be much more efficient out of this whole process, not having to have as many people working for them anymore. Maybe that allows for higher profits. And from a stock perspective, that might be a good thing. But there's just so many things to consider as we think about a rebounding economy there, which I think really makes the case for being careful with where you're going to invest this year. Okay. A few other notes as we start to kind of get on the tail end of our presentation here. I'm always fascinated by the oil story, and so much of our economy is driven by the oil story, as much as you may know it or not. Obviously 2020 is such a strange year because it's going to be the first year that the consumption of oil for the United States and China both went down, because obviously we're not flying places, we're not driving places, so consumption went down. But the big thing in the United States has been the increased production of oil until 2020, when they actually started to take some rigs off of the map because there just wasn't anything there for people to buy from. But that has limited our exposure and our volatility to that. With oil being cheaper and usually more stable, our companies can be in a better place to price their goods and not be so volatile when certain things happen in the world from a conflict standpoint. And there are times when this happens. This is COVID right here when the oil dropped down to $11. But little things do happen along the way. But for the last 6 years or so, we haven't had those big spikes that we saw in the 2000s or even during the recession. It's been a lot more stable. And I think it'll continue to be that way. The OPEC and Russia, have been sort of cutting their production in order to keep the price higher. While the United States is not part of that agreement at all, they can continue to produce and actually maybe have a bigger share of the overall economy's oil output, again, stabilizing the American economy as a whole. The Biden administration is certainly going to have a lot to say as far as renewable energy incentives go. So this chart I'm going to continue to bring up every year because I am interested in that trend and how it'll affect our investments. And companies that we thought were stable at one point may no longer become stable if that becomes a big story. Okay, let's continue really running through these. The international story we haven't talked about too much. I just want to give you some perspective on non-United States stocks. Because again, 1 year ago, I would have told you that international stocks look great because their valuations are much cheaper. You can see that, after the 2008 recession, the United States did very well. And then the international stocks really haven't gotten us a great return. Compared to what was happening in the mid 2000s, you can see the rate of growth with international stocks was great, while the United States was not doing that well. I'm still interested to find out what's going to happen on the international space. Specifically in the emerging market space, countries like those in Southeast Asia, where COVID is in a lot of ways contained, do seem to present a lot of growth opportunities. But so far, a lot of international stocks just haven't had that recovery yet. Still have cheap valuations and might make a case for making those investments. And this chart is actually going into evaluations, showing you that where the United States is compared to where they are versus other developed markets. Europe in particular is more expensive than usual. It's 25-year average, but not that much more expensive. And obviously Brexit has been a big part of that, and that has relatively come to I shouldn't say it's a solution yet because they're still negotiating a lot of aspects of that trade deal, but we have a little bit more stability in Europe than we have before. And then emerging markets is where I'm spending a lot of my time, looking for investment opportunities. Because again, if COVID is good and their valuations are cheap, that might be a good case for them. Okay, so let's close here with a few more slides. Obviously, the first 6 to 9 months of 2021 are going to be primarily based on what is happening with COVID-19. You're seeing some countries go back into lockdown in Europe, or China is locking parts of their country down. Obviously, vaccinations are becoming a big part of the United States story. I think right now, 700,000 people per day are getting the first dose of the vaccine, and they're hoping to grow that up to 1 million people a day, and hopefully having most of the population that wants that vaccine by June of this year. And so we'll continue to see how that rolls out compared to the growing case counts. And you can see that the increases of cases and then daily fatalities are just phenomenally high in Europe and the United States compared to Southeast Asia, North Asia, and Latin America. So for those two particular areas, this is a big topic. Those other areas, maybe not so much. Maybe there's a little more predictability there. Again, obviously, unless they have another outbreak. So no surprise yet that the first 6 months are going to be completely focused on that. But as we look at that, this is showing you the Purchasing Managers Index. So Purchasing Manager, this is a leading indicator trying to find out what kinds of economies are expecting to do well. Because if they're making new purchases and they're hiring people to produce certain goods, odds are that they're expecting those orders to be fulfilled and for their economies to recover. And I really like to kind of show you this. If we go down to China, for example, green is when the index gets over 50, which means an accelerating economy. Yellow and red would be when the index gets below 50. That means we're likely looking at a decelerating economy. Obviously, a lot of red here when COVID was starting. and a big red mark here for China because they had the most extreme lockdowns that have been seen in the world. But they also recovered more quickly because their COVID case counts were very low. Their problem is more so that the rest of the world hasn't recovered, and they don't. The rest of the world needs to buy Chinese goods, and they're not ready to do that yet. But they have recovered, at least from a labor perspective, and people are going back to work as normal. You can see their number here is at 57.5. But even the United States is up here as well, 58.6. Regardless of what you think should be happening or not happening, it's a fact that right now people are getting back to normal to some degree and producing goods. And we'll have to see if they'll be able to continue to do that in the first half. But you can see that there's a lot of opportunity here, whereas Germany has had a really hard time this year. Again, trying to export goods. They export a lot of luxury goods, a lot of luxury cars, for example, that people just haven't been buying. So their number is lower. It's at 51.7, despite even more stimulus than the United States has as a percentage of the economy. So maybe it'll be a German rebound there, but they really are waiting for the global economy to come back around. Okay. And so finally, this is the last slide that I was alluding to earlier in my presentation, which really hits home how to manage a portfolio with everything that's happening here. So this chart, let me spend a little time on it because this is showing you year by year the asset class returns. So in 2020, we saw that small caps were the best performing asset, emerging markets were second, large cap was third, and then fourth is an asset allocation strategy. We'll get back to that. Developed markets, fixed income, high yield, cash, commodities, and then these are real estate investment trusts. So out of the list, they performed worse in 2020. And that's not a surprise either. Obviously, a lot of people are not going back to their corporate offices. So a lot of concern about what these cities are going to do with their real estate that really hurt REITs for most of the year, but they did have a good recovery in the fourth quarter. So that'll be something to keep an eye on. But the thing I want you to take away from this chart, and the reason it's color coded, is just to show you year by year how much these asset classes are all over the map. So in a year like 2020, small caps were best. They were third best in 2019, but then they were below average in 2018. Again, above average, below average. And so if you pick any asset class, again, real estate investment trusts were worst in 2020. They were best in 2019. So what we try to do when we're looking at portfolios, one of the biggest things that we think we can do to add value is to rebalance accounts. So rebalancing just simply means that based on what your strategy is, if you're looking 10, 20, 30 years down the road, you're going to have a certain percentage in large caps, a certain percentage in real estate investment trusts. And as the years go on, you'll have that percentage change. So if I wanted to have 10% in large growth stocks and they have a great year in 2020, I'm no longer going to be at 10%. I'm going to be in like 13 or 14% because they've grown so much. Whereas value stocks, maybe I wanted them to be at 10%. Now they only make up 7% of my portfolio. So rebalancing means I'm going to take 3 or 4% from the growth and put it back in the value, essentially selling high and buying low continuously. And that can be a frustrating strategy if you're watching returns over time, because if you were selling off large growth stocks for the last 2 or 3 years, you just watched them continue to go higher and thought, why did I sell those stocks? Why did I sell my Amazon? Why did I sell my Tesla stock? It just continued to run. But over the long haul, your best way of going through things typically is to have an asset allocated strategy. And you're going to live kind of in the middle of this chart here without having to guess which of these categories are going to do best from year to year. I've given you some ideas as we've gone through this presentation of what categories could be looked at, but things change. And as we kind of conclude our presentation here, I would just kind of remind you that the greatest risks are completely unanticipated. So again, COVID-19 is just, couldn't make up a better story for something that would be more unanticipated than COVID-19. And when March of 2020 was happening, we had that big drop because there was complete uncertainty and very high volatility. So we'll talk about what might happen in 2021, but it might be something that occurs that was completely off of our radar, which will be fun to revisit a year from now. As I've said before, the market expects a snapback in the economic activity once cases drop. Pent-up demand in travel, strong household balance sheets, and low interest rates should all help this year. Increased worker productivity due to technology can reverse the recent trends where productivity was actually declining in the United States, and was a big concern both with the demographics of what the United States was happening and productivity. But that actually might change based on what's happened this year. So that's a good thing. On the downside, though, anything that happens with delayed vaccine rollouts, if inflation gets high, as I mentioned, if we have long-term changes in behavior, everybody's expecting the American consumer to just go gangbusters when the economy recovers, but some may not, be willing to do that. Maybe we're actually going to be saving a lot more money than we've typically done in the past. And if that happens, we won't have these projections kind of bear out, and they'll take a lot longer to come to fruition. So those changes in behavior could affect the economy moving forward. And then higher tax rates could also stunt that growth. I mean, if we have higher tax rates across the board, we'll kind of see what happens here. But that gives less money for the American consumer to be able to put back into the economy. So just things to watch as we go into 2021. Overall, I'm relatively optimistic. I'm still investing in stocks as we move forward, certainly with bonds for my retiree clients, being more careful there. But again, just not getting a great rate of return in bonds these days. So we're looking for those stable companies that can provide dividends for our retiree clients, not just domestically, but internationally as well. And so with that, we'll kind of conclude the presentation by just reminding you about our company, our website, First National Corporation, fncadvisor.com, where you can see a lot of different resources here. You can go to our blog, you can sign up for our newsletter, where we talk about this every quarter, just to give you a sense as to what we're seeing. We also have a resource here for any dentists in the presentation to sign up for a free ebook. You can just go to fncadvisor.com/dentist, and this will give you a really good foundation for how to financially plan as a dentist. I'll tell you that even these first 8 chapters and the last 3 are great for anybody, even non-dentists, but I think dentists will find this middle section particularly interesting. And then finally, I'll leave here with all of my contact information. fncadvisor.com/blog, as I mentioned, is where we put our articles. And then my LinkedIn, my email, and our phone number if you want to get in contact with us in any way. So again, I appreciate everybody joining the webinar today. 2020 was a very tumultuous year. I don't expect 2021 to be too awful different, just in a lot of different ways. I'll look forward to seeing you at our next webinar in early February, and hope to keep you in the loop with what's happening. So thanks again, everybody. Take care.